Hello, everyone, and welcome back to Sudden Wealth. I hope you're having a very good end of the weekend, getting ready for the big week. We are almost at mid-December, believe it or not, my God. And I hope you guys have some plans, for the holiday season, for New Year's Eve. Try to enjoy some time with the family. The volume in the markets should start to go down quite substantially over the third week of December. So probably this week will set the tone for the remaining of the year. Now, don't forget, if you do enjoy the content, please consider dropping that like and subscribe. We are 13 or 12 subs away from the magical number of 800. So thank you very much once again for your support. And that's the only thing that I ask, as you know. Now, as we are approaching the end of the year, and I always like to take Sundays as a bit more of a macro view of things and not necessarily the short-term stuff. But in any case, let's take out the short-term stuff out of the way. Bitcoin stays close to 44K. Again, as long as we are above 45K by end of January, we are still in line with the cycle. Ethereum should now start to also outperform Bitcoin, particularly in January. That's how it tends to go. In terms of stocks, again, we are on the higher range of the 4,600 in the S&P. I do believe we're going to make a push to try to go a little bit higher. We'll see if we can do it or not. I do think, we are 800 points away in the Dow Jones from a new all-time high. I do think we are going to see those by Q1 2024, as I've been saying in this channel for months and months and months. Now, the question is, I made that prediction around June or July. At the time that everybody was telling you that Q3, Q4 for sure was going to be a big recession. That's it. Rate cuts by September, October. That was all the predictions. All the banks forecasting rate cuts. All the YouTubers, like Meet Kevin and the Great Reset, the Great Depression coming. Of course, then you have the Peter Schiffs and the Harry Dents who predict the collapse all the time. By the way, both Peter Schiff and Harry Dent predicted that we were not going to see new all-time highs in the stock market for years and maybe decades. And when they say years, they say years and years. Just like the Great Depression, it took 25 years for us to see the new all-time high. So they were giving the same type of vibe. So I'm actually quite curious to see what they're going to say when we do hit the new all-time highs. Now, I've mentioned this before. Seba, why were you so confident that there's not going to be any recession and that stocks are going to move higher? Well, basically for the same reason that now I think that a recession may be likely in next year, which is literally everybody was predicting it. I mean, you couldn't, not only the mainstream media, the CNBCs, Jim Cramers, and all these clowns, but I mean, you couldn't open a video on YouTube that wasn't about the upcoming crash, the upcoming depression, the recession, the rate cuts, when it's gonna cut, it's gonna be September, October, blah blah. No, whenever everybody's looking at this like that, and everybody's expecting the same, and everybody's listening to the same information, then you get the opposite. It's just how markets work. You see, the issue with YouTube finance people is that they've been around since 2008. And I've also been around since 2008, but actually I spent huge amounts of time studying what came before. And believe it or not, there was a time where the stock market was going higher and interest rates were also considerably high, I mean. So there are worlds where interest rates can be higher and stocks can go higher as well. The problem is, because most people that talk in the TV shows, talk on YouTube, have only been around in the last 10, 15 years. They've only seen, okay, Fed cuts rates, print monies, fast forward 3 to 6 months, stocks and risk assets start to go higher. They raise rates, like in 2018, and the stocks crash. They raise rates, 2022, and the stocks crash. Now, there is a period of of getting used to the higher rates. You see, if you have lower rates, low inflation, growth, blah blah blah, stability in terms of conflicts, etc. Basically, your stock market is priced for perfection. So if you tweak the rates higher, or if you start increasing rates, you are removing the perfect scenario, and you are introducing uncertainty, difficult to say what's going to happen. Obviously, the cost of debt goes higher for companies, so it's harder for them to have so good the same level of results, etc. So basically, what I'm trying to say is you had a setup basically in 2021 where everything was poised for perfection, everything was positioned for perfection. Once you stop having the perfection, you have a big correction. Now, what I was arguing for, even at the time, is what the Fed is looking to do is to have rates higher as much as they can. And then, of course, fast forward a few months and you start seeing stuff like higher for longer, which is basically what I've been saying for 3 months. Now, the Fed wants to do it, and there is a world where stocks and other assets can still go up despite interest rates being higher. The question becomes, so in my opinion, just because we were raising rates, yes, you would introduce some short-term uncertainty, and basically 2022 was a bad year for stocks, but I was still convinced that we would see new all-time highs by Q1 2024. As it typically is what happens whenever we go through these, if you will, rate hiking cycles. The point is the economy started to shift into tolerating higher interest rates. Now the question becomes, is this sustainable? Will this happen into the future? Before that, very important. Most people think that low rates and money printing means inflation. No, it doesn't. We've had 30 years of Japan printing way much more money than the US, way much more money than Europe, and still at 0%. See, it depends on how you print it. Now, if you tell people to stay home, don't produce anything, and you send them checks in the mail to everyone in the country, oh yeah, you're gonna have inflation. There is no doubt about it. Because basically you're giving direct money to people to spend, and there is less stuff around, so you're gonna see the CPI going up, which is the inflation that basically everybody cares about. But the way that QE works, that's not the case. Because what happens is rates go lower, so banks fund themselves with the central banks cheaper, so they can also lend it out to the population cheaper. Why don't you see the same levels of inflation? Well, because if you're a person with a terrible credit score, if you're a person already super indebted, if you're a person filled with credit card debt, student loan debt, mortgages, car payments, you name it, the bank's gonna look at you, and even if interest rates are zero, they don't think they're gonna get their money back, so they tell them, no, we don't lend you money. Do you know who we lend money to in that scenario? To the top 20% richest people in the country. The top 20% richest people in the country own 90% of real estate, stocks, commodities, bonds, etc. So those people get a huge benefit. So that's why when Nixon took the dollar out of the gold standard, and basically you were able to start printing money more often, the wealth gap started increasing. And as you can imagine, over the last 15 years, it dramatically increased. The reason is very wealthy people, Bill Gates, Elon Musk, or people with very high paying jobs, good credit scores, lower debts, they can go to a bank, have loans, and buy assets with it. So for them, it does improve their quality of life. For people who are already indebted, live paycheck to paycheck, have huge mortgages, they don't have access to that money. So you can lower rates to zero, you can print a bunch of money. If you don't give it directly to people, that will not enter the economy as you'd expect. But here is the key. Let's say you are in the top 20% of the country. Let's say you have a good job, you have a mortgage. Let's say you're a millionaire or a billionaire, if you will. How many dinners are you going to have? Are you going to start having 5 dinners? No. Are you going to start having 3 lunches? No. You may have 10 cars, but will you drive 10 cars in one day? No. Let's say you have 5 houses. Okay, but are you buying stuff for the houses every single day? No. So what I'm trying to say is you can be extremely wealthy, you have unlimited money, if you will. That doesn't mean that all of a sudden you're gonna consume so much that you raise the prices across the entire economy. Now, granted, the top 20% account for 50% of spending. So all in all, they do spend more money than average person. But if the average person is not spending more because they are not getting access to this cheap credit, easy money, then the whole thing gets some degree balanced out. And that's why you can have a lot of money printing like in Japan. Japan printed more than 150% of its GDP over 10 years or 20 years. And they still have 0% inflation. And this is a country that needs to import everything because they have literally zero oil, zero gas. I mean, they need to import everything you can imagine. And they still have 0% inflation. Nowadays, they have a little bit more than that. But that is the reason why. That is the reason why China is also back to stimulus, yet they are recording deflation because the level of bankruptcies is bigger than the stimulus that has been printed. It's really that simple. Now, the question becomes, is this sustainable? Will we be able to see these interest rates higher for longer? And my answer is no. So next week we have the Fed meetings, which I think they're going to pause again. I don't think they're going to raise rates, and we're going to have the inflation numbers. I checked the European levels of inflation, which they were expected that the Eurozone was expected at 2.8, came out at 2.4. You have certain countries already below 2%. I do think we're going to see a good print on inflation, and basically a print on the right direction, meaning downwards, which is going to fuel the fire for cutting rates into the future. Now, I think the Fed personally would like to get out of this printing money, rating cuts, and manipulating these rates so much. However, I do believe they're going to feel the pressure to do it, particularly because if it becomes clear that a recession is coming and we are in a re-election year, well, I get the feeling that the non-political Fed, the independent Fed, will become once again not so independent. In any case, it will always be unsustainable over a long period of time for a very simple reason. The US has dramatic trade deficits, which means they need to borrow that money, and they have brutal budget deficits, which means they also need to borrow that money. So if you have the Treasury borrowing money, meaning issuing debt into the market, the Fed doing QT, also selling bonds into the market, the allies selling dollars into the market because they also want to de-dollarize, and the enemies like China, Russia also selling their bonds into the market, you have far too much selling pressure, and the problem is this compounds, right? So if you have a budget deficit of 2 trillion, then your debt goes up by 2 trillion, so the interest payments on that debt is now much bigger, which means you also need to borrow that money, which means the interest payments go higher, which means you also need to borrow that money, blah, blah, blah. So this thing goes out of control, and the only way to postpone that level of pain is by cutting rates and keeping them. I wouldn't be surprised. This is a crazy statement that I'm going to make, but if by the end of the decade we would see negative rates, I'm talking negative nominal rates, meaning actually not the real rates. So real rates is the nominal. Let's say the Fed sets the rates at 5%, but inflation is 7%. So the real rate is -2, but the nominal rate is 5%. What I'm saying is the nominal rate actually going negative would not surprise me by the end of the decade. We'll see if I'm right on that. But that's the point. And here is the key. Yes, higher interest rates make it more difficult for businesses. All those things are true. But when these people were making all these crazy predictions, they think that these things are automatic. You know, you raise rates today, the whole thing collapses in a week's time, and then you lower rates tomorrow, and then the dollar loses all the value in 1 week. I mean, it's like that, right? This is one of my favorites. Oh yeah, once they start cutting rates, the dollar will collapse. Based on what? because China is already doing that. Do you think there's going to be a world where the US is printing money in country rates and Europe is not? And Japan is not? So compared to what? That's the key. To what are you comparing with? That's also typically, they look at the dollar in isolation. Like if what the US does is unprecedented and only the US does it and all the other countries don't, which to me is a very stupid mistake. But in any case, the point being, when you listen to these economists and these forecasters and these financial experts, is that they think that these things happen and filter throughout the system in, give it a couple of weeks, a couple of months, and all of a sudden, no. These things sometimes take years to play out. That's why you should make your investments, in my opinion, based on what you can see over the next 3 to 6 months, and other than that, you're playing guessing work. And I mean, guessing, sure. I mean, maybe you hit the lottery, who knows? But the longer you go, the further you go, the more likely it is that you look like an asshole. So with that, I leave you be, guys. Enjoy the rest of the weekend. Don't forget, like and subscribe, and I'll catch you in the next one.